U.S. natural gas futures started the week with modest gains, building on Friday's rebound after prices successfully defended a key short-term support area. The weekend weather data showed a noticeable colder shift across the eastern half of the U.S. for November 4th to 6th, which provided an early spark for a stronger opening in natural gas trading. However, after the initial pop, December 2025 futures experienced a round of selling before recovering again, a pattern that could be tied to several overlapping factors, including the upcoming expiration of November contracts between Tuesday and Wednesday. The late-week pullback was driven initially by profit-taking following the strong rally, and later reinforced by higher production levels and market reaction to Thursday's larger-than-expected EIA 87 billion cubic feet injection. Natural gas inventories now appear on track to peak just below 4,000 billion cubic feet in early November, a level that underscores the market's comfortable supply position heading into winter. On the other hand, if colder weather trends take hold in early to mid-November, that surplus could erode faster than anticipated, potentially reviving bullish momentum just as traders start to price in genuine winter demand. From my perspective, this kind of choppy behavior isn't surprising at all given the market's current sensitivity to weather trends. Traders are clearly on edge, watching every new forecast update for signs of sustained cold that could finally ignite meaningful heating demand. The real question now is whether the colder outlook for early November will persist, or even extend into November 7th to 10th. If it does, it could lend more credibility to the idea that winter risk is finally coming into play, something the market has been waiting for but hasn't yet fully priced in. Meanwhile, fundamentals continue to weigh on the market. The latest EIA report revealed a larger-than-expected 87 billion cubic feet injection for the week ending October 17, lifting storage levels to 4.5% above the 5-year average. Production remains exceptionally strong as well, with lower 48 output hitting a record 108.5 billion cubic feet per day on Friday, up 5.5% from a year ago. The EIA's 2025 forecast of 107.14 billion cubic feet per day only reinforces this oversupplied backdrop, suggesting that any weather-driven rallies are likely to face strong headwinds from persistently high production and ample storage. Despite today's early strength, the broader setup still leans bearish, with roughly a 60 to 65% probability of further downside unless new bullish catalysts emerge. Traders are watching resistance at $3.40 and $3.50 closely. A sustained move above $3.50, which I'd give only a 35 to 40% chance in the near term, could shift momentum and open the path toward $3.80. However, if prices fail to hold above $3.40, it would likely confirm that the recent rebound was just a short covering bounce rather than the start of a lasting uptrend. On the downside, the $3.10 support band remains critical. A clean break below this range would likely trigger a sharper sell-off, potentially testing new multi-week lows. Don't forget to comment, share this video to support the channel, and show some love. See you next time.